Listen up, folks. In the wild world of trading, knowledge is power. And one powerful tool you need in your arsenal is the Relative Strength Index, or RSI. This handy indicator tells you if a stock is overbought or oversold. Basically, is it time to buy or sell? Think of RSI as a gas gauge for stocks. Ranging from 0 to 100, it gives you a read on the stock's momentum. A high reading above 70 means the stock is overbought, like a car about to run out of gas. A low reading below 30, that's oversold, signaling a potential buying opportunity. Now, RSI alone isn't a magic bullet, but paired with other indicators and a solid strategy, it can be your secret weapon. It's all about understanding what it's telling you and using that information to make smart trading decisions. So, buckle up, because we're about to dive deep into the world of RSI and how it can help you navigate the markets like a pro. Don't let the fancy name fool you. Calculating RSI isn't rocket science. It's all about comparing the average gains to the average losses over a specific period, usually 14 days. First, we look at the price changes over those 14 days. We separate the up days from the down days, and calculate the average gain and average loss. Then, we plug those numbers into a fancy formula that spits out a number between 0 and 100. Voila, that's your RSI. Remember those key levels I mentioned before, 70 and 30? They're your warning signs. When RSI crosses above 70, it's time to pay attention. The stock might be overheated and due for a pullback. Conversely, when it dips below 30, it could be a sign that the stock is oversold and ready to bounce back. Now don't go hitting the buy or sell button just yet. RSI is just one piece of the puzzle. But understanding these levels and what they represent is crucial for using RSI effectively. Now let's talk about RSI divergence, a powerful concept that can give you an edge in the market. Divergence happens when the price of a stock and the RSI are telling different stories. Imagine this. A stock is making new highs, but the RSI is making lower highs. This is called bearish divergence, and it's a warning sign that the upward momentum might be fading. Like a tired marathon runner, the stock might be running out of steam. On the flip side, bullish divergence occurs when a stock makes new lows, but the RSI makes higher lows. This suggests that the selling pressure might be weakening and a reversal could be on the horizon. Spotting these divergences can be incredibly valuable. It's like having a crystal ball that gives you a glimpse into the future of a stock's price movement. But remember, it's not foolproof. Always use RSI divergence in conjunction with other indicators and analysis. Section 4. RSI in action, real-world trading examples. Let's bring RSI to life with some real-world trading examples. Imagine you're eyeing a stock that's been on a tear. The price is skyrocketing and everyone's jumping on board. But hold on, you notice that the RSI is above 70 and starting to form a bearish divergence. What does this tell you? It could mean that the bulls are getting tired and a pullback might be in the cards. This doesn't necessarily mean you should sell all your shares, but it's a sign to proceed with caution. You might want to tighten your stop-loss orders or take some profits off the table. Now let's flip the script. You're looking at a stock that's been beaten down, the price is plummeting and everyone's heading for the exits. But wait, you spot bullish divergence on the RSI. The price is making new lows but the RSI is making higher lows. What now? This could be a sign that the selling pressure is easing and a reversal could be brewing. It might be a good time to start accumulating shares, but remember to do your due diligence and confirm the signal with other indicators. Section 5. RSI and friends, combining for success. Remember folks, RSI is most powerful when it's part of a team. Combining it with other indicators and strategies can significantly improve your trading accuracy and help you make more informed decisions. One popular combination is using RSI with moving averages. For example, you might look for buy signals when the price crosses above its 50-day moving average and the RSI is above 50. This confluence of signals can increase your chances of catching an uptrend. Another powerful strategy is using RSI with candlestick patterns. For instance, you might look for bullish candlestick patterns like a hammer or a bullish engulfing pattern when the RSI is in oversold territory. The key takeaway? Don't rely on RSI alone. Use it in conjunction with other tools and strategies to create a robust trading system that works for you.